post its listing. Now, as promised, let's focus on Sai Life Sciences. That's the 3,000 crore plus IPO, 3,000 crore rupee IPO, which opens today. There's a fresh issue. There is an offer for sale as well. And we have the management now joining us. Krishnam Raju Kanumuri is Managing Director and CEO. And we have Sivaramakrishnan Chittor, who is the Chief Financial Officer at Sai Life Sciences. Both are now joining us to take some questions. Gentlemen, great to have both of you here. Thank you very much for being on the program. Prashant, this side. Krishnam, if I can start with you, briefly, if you can sort of, in a way, pitch your company to your to the viewers who are watching. A little bit about the company. You're in the contract manufacturing space, the CDMO space. Sort of where are most of your clients based out of? What have been growth rates like? And of course, then come to the point of what the money that you are raising is going to be used for. Go on.
So, Sai Life Sciences, again, we're a contract CDMO, but we're a little differentiated from most of our Indian peers. We are more an integrated service provider all the way from discovery services, from when the concepts are started, all the way to commercial manufacturing. We are modeled more like the largest companies in China, WuXi and Pharmaron, which are the most successful companies over the last decade or so. But their strength has always been able to start with companies right at the discovery stage and work with them all the way through to commercial launch. This becomes very, very important in today's market environment, where large pharmaceutical companies and biotech companies want to go to market faster, and they want to work with one company as a one-stop shop. So there's no real need for them to move from company to company, which gives them the speed they need. And over the last 5 years, we've re-looked at how to build the company to make it a truly world-class company. And we went and built a world-class campus. We started operations in Manchester, UK, started operations in Boston, Massachusetts, tried to really build world-class talent, world-class ability to the company, and invested in brand new infrastructure. Most of our plants are now built to global standards across the board. And this has really made a big difference for us. If you look at our growth trajectories over the last 3 years, we've significantly outgrown the industry, both in terms of top-line growth of CAGR over the last 3 years, 50% plus in terms of EBITDA margins. And this is really built on a sustained strategy to differentiate ourselves and truly give a world-class alternative. As the world is looking at more decentralized supply chain post-COVID, and these tailwinds are likely to continue for several years, because I think every company we've talked to wants a more robust supply chain of scale. And I think we're well positioned to win business across the spectrum. And given the fact that we work differently from most companies, we have a much broader sales funnel, which people can start with us in discovery, start with us in development or manufacturing. So it gives us a much broader set of service offerings. Also, a customer base. We work with 18 of the top 20 pharma companies, and it's very hard to get that much penetration into the best companies in the world, and we've done that successfully. So I think we're very well positioned for growth as we move forward. The proceeds, we are using majority of the proceeds to pay down debt, to lighten the balance sheet, and also give us the opportunity to expand as opportunities arrive in the market. We are working with a lot of our customers who indicated what they need from both the capacity standpoint and capability standpoint. So we'll deploy these prudently at this point.
All right. Good morning, gentlemen, and welcome to the show. Since around 720 crores will be utilized to repay debt, will you be debt-free post that? Point number one. And on this 700 odd crores, the interest savings will be in the vicinity of around, 75, 80 crores? Should that be the broad interest saving?
That is correct. I think absolutely right. I think, once you repay 720 crores of debt, we will have very negligible debt. So if you look at what 75, 80 crores of saving, that actually, if you look at FY24, that almost translated around 5.5% of revenue. So they will all translate back into, profit before tax.
Got it. All right. Got that out of the way then. So there'll be some interest savings as well. I just want to understand the financials. As you all were mentioning, that you all have grown quite well. Now, if I just look at FY22 and I compare it with FY24, the revenues are up by around 60% approximately. But the EBITDA number has more than doubled. And that's why margins as well have moved to around the 20% odd mark. Could you explain to us how did this happen, the EBITDA number moving more than twice and also margin improvement? And should we work with this sort of a margin band, or is there further scope for improvement?
So I think what you're seeing, I think Krishna talked about setting up the business from a longer term perspective. So 3-4 years ago, we took a stab at saying we will want to transform this business to go compete globally. And we said what would be the ingredients that are needed to get this business set up for a longer term success. And then we identified a few areas, which is people, infrastructure, and then we went about, clinically executing each one of them. Some of them included adding a nearshore center, which is, UK for our process chemistry, and then US for biology. And then we also, made changes to our infrastructure to kind of match global standards in terms of containment, in terms of how we do certain things within the plant. So I think all of these kind of helped us, win new customers. If you look at where we are today, we're working with 18 out of the top 25 pharmaceutical companies. That is as broad as a customer base that you can get to, because the top 20, 25 pharma companies pretty much control all of innovation. And to be with all of them kind of means that there is a lot of room for us to grow as an organization. But in the shorter term, if you really look at, a lot of them will mean increased operating expenditure, also increase employee costs as we kind of stabilize these centers. Also, taking the fact that some of these centers came into operation right around COVID. So there were those initial impacts of COVID that kind of, hit us during fiscal 22 and 23. I think the beauty of the manufacturing business lies in operating leverage. You're exactly right in terms of saying that, profit just jumped from 22 to 24 while revenue wasn't growing at the same clip. Now,
Yes.
The reason for this is operating leverage. And our belief is that the operating leverage growth that you're seeing, just kind of gives you the story in terms of how business can grow when operating leverage comes into play, without getting into any forward statements. But I think, the way we are looking at, we have a lot of, we have a lot of new molecules that we have picked up over the last, 2 to 3 years. Our product portfolio is very young, and, which just tells us that as these products kind of, get to market and kind of grow, there is a lot of potential for our business
So margins
to grow. That's what we believe.
So the short point you're trying to tell us is, because all the measures that you just mentioned, the margins at these levels are sustainable. Is that correct?
Would not want to make a forward statement.
No forward
Krishnamji,
statement,
but
sir.
What I would like to say is...
No forward statement, sir. This is Nigel on this side. Just want to ask you, maybe 100 basis points lower and scope for improvement. Would that be a broad understanding with regard to the margin trajectory? Because it's improved from 15% to 20%, which is phenomenal because of all the reasons you said. But do you think it can be maintained at these levels?
Our belief is that margins going forward should improve, even further from where we are. Just given the fact that the pipeline is younger, commercial products are getting into larger volumes for our end customer, which would then mean larger manufacturing, which would mean more operating leverage in the business, particularly when you have incurred all upfront costs on our R&D businesses, particularly in UK and US. And then when revenue starts flowing and then commercial revenue starts coming in, the overall expense ratio comes down, and that's where leverage will kick in. And we believe that these are there, and these are exciting times for the business.
Absolutely. And I think your potential shareholders will like the sound of that your margins can improve from 20%, because a lot of the listed peers, they're operating at margins above where you are right now. So you're saying this operating leverage should help improve your trajectory. Mr. Kanumuri, just to come back to the point on growth, and I know you can't give a very specific number for this year, that's fine. But if we just look at the trend, in FY23, the company grew at 40%. In FY24, the growth was 20%. This year, first half, the growth is just about 5%. Now, tell us, what is a sustainable, steady state growth profile? And the reason I ask you this is that there's so much excitement around CDMO companies. Also, just tell us, what are you factoring in from the US market? There's a lot of chatter around this Biosecure Act, whether it's getting deferred and whether eventually Indian companies will benefit or not. So tell us, what is a steady state growth profile and what are you factoring in terms of fresh regulation on the Biosecure Act from the US when you look at your growth potential?
Look, I don't want to get into future statements, especially steady state, but I think the growth profile is likely to stay strong for the next 5 to 10 years. And I just want to kind of point to the fact that our growth has come in pre even any shadow of Biosecure. I think what has changed in the last 3 years, irrespective of Biosecure, is just a part of the entire global winds changing. Just right after COVID, I think most companies have made the decision that they want a more robust global supply chain. And it's no longer a China plus one supply chain because they want a supply chain of scale across geographies. And as companies have looked at Europe, US, India more broadly, they realize India is probably the only country which can probably match the scale of China as well as the cost structure what China can provide over the next 5, 10 years. So there's a lot of confidence building going on right now with most of the global pharma companies basically working with us more deeply across different product lines and also giving us much more forward visibility on what is important for them in the next 5, 10 years. So I would think this trend is likely to continue the next 5, 10 years because it's strategic in nature. I don't think there's any reflex reaction with respect to Biosecure specifically. It's more a question of companies being comfortable that they have partners globally where they can single and double source, at least double source most of their efforts of scale and quality, which gives them comfort going forward. And India as a country has all the ingredients in place. We've been doing this for 20 years, very strong pharmaceutical background, excellent talent, reliable costs. And I think these will play a big part, not for us itself, the sector itself is going to do well in the next 5, 10 years.
Is there a way of quantifying that, Mr. Kanumuri? I mean, we understand, but the thing is, I think analysts and everybody's kind of scratching their heads, trying to put some sort of a number to this opportunity. If indeed the Biosecure Act goes through, and if it's not, deferred for too long, then some opportunity, maybe not for your company per se, but for Indian CDMO players overall.
If I had to take a gut feel move, I think if India, let's say pure CDMO opportunity, China must be 30 billion plus in market sales at this point. India is probably in the 2 billion range. Even if I think a minimum of 3 to 4 times in whatever duration, I don't know, but at least I think 20% of the market 20 to 30% market can come to India. And that number itself is very significant from where we are today, which is less than, I would say, 10%.
Krishna, just one last point. How much would private equity players own after all of this? And you've had Sequoia earlier, Tata Healthcare earlier, TPG now, HBM. I mean, what would be? How much would private equity own post issue?
Post issue, I think. Go ahead, Shiva.
I think what I wanted to kind of post issue, TPG will continue to own a little less than 25%, and HBM will own around 2% of the company. But I want to point out is I think the question on the excitement around the industry. I think if you look at the DRHP that we had filed, both TPG and HBM had presented a higher OFS number, but I think they've all looked at where the market is. They've looked at what industry is saying, what global analysts are saying about the CDMO sector being hot. There has been a reduction in the OFS both from TPG and HBM. HBM has been around for more than 10 years. TPG has been invested in the company for more than 6 years.
All right. Got that. Thank you very much for joining us. Good chat, and we wish you all the luck with the IPO. And I think we'll speak again on day one when the company makes it to the public markets. Thank you once again for joining us this morning. Well.